If you blinked on Friday, you missed it. Silver went from unstoppable to unrecognizable, a $121 handle, and then a straight line fall into the 70s. Phones lit up, screens froze, the chat rooms turned into emergency rooms, and the question that spread faster than the selling was simple. Was this a targeted attack, or just a market finally snapping? Let's put hard numbers on the pain. Peak Thursday, January 29th, 2026. Spot silver around $121.60. Friday, January 30th, an intraday low near $75.40. That's a 37% air pocket in a single day. COMEX futures printed similar violence, roughly $121.78, down toward $78.29 on settlement measures. SLV got clipped almost 30%. And if you were in leverage, products like 2x silver ETFs, your screen looked like a trapdoor. Here's why this matters. Big declines happen. But collapses like this in one session are usually not one reason. They're a chain reaction. And the only way to understand a chain reaction is to stop blaming one domino and map the whole line. So let's map it. The day had a headline catalyst, the nomination of Kevin Warsh as the next Federal Reserve Chair. Forget personalities. Ignore the noise. Markets trade expectations. And for months, the precious metals trade had built a very specific story. Policy will loosen, the currency will soften, and hard assets will levitate. That story doesn't need to be true to move price. It only needs to be believed by enough size at the same time. Then the headline hit, and the story got edited. Not rewritten, edited. Warsh is widely perceived by markets as more disciplined on inflation and more skeptical of easy money. That perception matters because silver, at 100 plus, becomes hypersensitive to anything that looks like higher for longer. In plain English, if traders suddenly think rate cuts are less certain, they reprice everything that was built on cheap liquidity. The fastest way to see that repricing is the dollar. A sharp dollar move turns metals into a lever, because when the dollar strengthens, dollar-priced silver becomes more expensive for the rest of the world instantly, less foreign demand at the margin, more selling from macro funds, and suddenly the debasement trade isn't a one-way street. So if you're hunting for motive, start here. Not someone attacked silver, but the market attacked its own crowded narrative. Silver didn't crack at 120 more. It cracked when it failed to hold key psychological levels on the way down, because the market is not one crowd. It's layers, and each layer has a switch. Above $100, you had momentum money, trend followers, and late arriving retail. Below $100, you hit the first tripwire. Stops. Stops are not opinions, they're instructions. When price hits the stop, the platform sells. It doesn't ask you how you feel. Multiply that across thousands of accounts, and you don't get a sell-off. You get a stampede. Then comes the second tripwire, margin. Silver had been up roughly 60% in January. That kind of move attracts leverage like gasoline attracts sparks. So when the fall started, margin calls didn't wait for the close. They arrived mid-session, and a margin call is forced selling at the worst price with the worst liquidity. This is why the tape looked unreal, not because the metal changed, because the ownership changed, fast, from confident hands to forced hands. Now let's talk about the part most people feel but can't name. Why did it feel like there were no buyers? Because in modern markets, buyers are often liquidity providers, market makers, algorithms, high-frequency systems that quote both sides until they don't. When volatility spikes past a threshold, a lot of those systems do the same thing. They widen spreads, reduce size, or pull quotes entirely to protect themselves. That creates a vacuum. And in a vacuum, even a normal sell order becomes a battering ram. So the sequence looks like this. Price breaks a level, stops fire, volatility jumps, liquidity providers step back, price drops faster, more stops fire, and the process accelerates. That's why people say, the buy button disappeared. Sometimes it's literally platform risk controls. Sometimes it's simply that the bid is thin, the spread is wide, and your market order is a wrecking ball. Either way, the experience is the same. You're trying to exit a crowded theater through a door that just got smaller. Then we had the rumor wave. Mid-crash, reports circulated suggesting a policy rethink around silver's strategic status. Whether it was misunderstood, exaggerated, or simply wrong, it didn't need to be confirmed to do damage. In a fragile tape, rumors act like matches. They don't create the dry wood, they just find it. This is why Friday's crash felt targeted to so many traders, because the rumor landed at the exact moment the market was weakest. And when timing is perfect, humans assume intention. But markets don't require intention to produce devastation, they only require fragility. Let's separate emotion from mechanics. The targeted attack theory usually implies coordination. Someone wanted to smash price, trigger liquidations, and scoop the wreckage. Could that happen in markets? Yes. Does it have to happen for Friday to make sense? No. Here's the cleaner explanation. A crowded trade met a macro repricing, At the same time, a key technical level broke. Inside a market dominated by automated liquidity, while leverage was piled high, and a rumor hit at peak vulnerability. That is a perfect storm, and perfect storms create outcomes that look like sabotage. So instead of asking, who did this, ask a better question. What conditions made this possible, and are those conditions gone? Part 6. The strange clue. Physical premiums didn't collapse. Here's where the story gets interesting. Even after the paper price was crushed, physical premiums in the US and Europe stayed stubborn. That's the split you always need to watch. Paper sets the headline, physical reveals the stress. If the crash was purely a story unwind, you'd expect physical demand to vanish too. But if premiums remain elevated, it suggests end users and long-term holders still want metal, even as paper traders are forced out. This is why you'll hear two narratives at the same time. Institutions saying, healthy correction, it was 100% above the 200-day, and physical buyers saying, support is forming, the industrial deficit didn't evaporate overnight. Both can be true. Price can be overextended and still be structurally tight. If you want to stop being surprised, watch the plumbing. Here's your checklist for the next 72 hours and the next few weeks. The dollar and real yields. If the dollar keeps climbing, it keeps pressure on metals. If the dollar cools, silver can breathe. The $80–$85 zone. Not because it's magic, because it's where psychology flips from panic to bargaining. A hold creates a base. A failure invites another liquidation wave. Volatility and liquidity. If spreads stay wide and candles stay violent, the market is still unstable. Stability returns when price moves stop looking like cliffs. Futures positioning. If open interest collapses, it means leverage has been flushed. That's painful, but it's also how bottoms form. Physical signals, premiums, back orders, delivery chatter, and tightness at the dealer level. Paper can fall fast, physical usually moves slower, and that lag contains information. Friday wasn't a morality play, it was a stress test, a reminder that silver is not a bond. It's a volatility instrument wearing a precious metal costume. And here's the real takeaway. When everyone is on the same side of the boat, it doesn't take a monster wave to flip it. It takes a small shift at the wrong time when the boat is already overloaded. If you want me to make a follow-up video breaking down the next key levels and the paper versus physical signals in real time, type one word in the comments, delivery. And if you got caught in that 37% drop, don't disappear, tell the story. It helps other people learn without paying the same tuition. Here's the pattern that shows up again and again in violent metals days, and Friday followed it almost perfectly. Step 1. Euphoria. The chart goes vertical, and every pullback gets bought. People stop using sentences like if and maybe. They start using sentences like inevitable. Step 2. The first red candle that doesn't bounce. Not a dip, a punch. That punch matters because it changes the behavior of the crowd. Buyers who were fearless become cautious. Cautious buyers don't chase, they wait. Step 3. The gap between waiting and bidding. When enough buyers wait, the book thins out. So the next sell order doesn't meet a wall of bids, it meets air. Step 4. The level breaks. On Friday, once silver lost the $100 handle, the market didn't just lose a number, it lost a story. This is the new floor. When a story dies, the exit door gets busy. Step 5. The liquidation waterfall. This is where you see candles that look impossible, because they're not opinion candles, they're forced order candles. And step 6. The post-crash silence. After the waterfall, everything gets quiet. Not because it's over, but because the market is counting survivors. You heard analysts repeating one phrase, it was far above the 200-day. That can sound like hand-waving, but there's a reason it matters. Big systematic funds use long-term averages as a gravity gauge. When price stretches too far above the 200-day, it signals overextension. Overextension attracts two things: profit-taking from the early buyers and short-selling from mean reversion systems. Now combine that with leverage. When the first wave of profit-taking hits, it's not absorbed by fresh demand, because fresh demand is already in. That's the definition of crowded. So the 200-day isn't magic, it's a warning light. And on Friday, that warning light became a reason to press the sell button. When people say liquidity got wiped, they mean this: you could sell, but you couldn't sell gently. Every exit came with slippage, and slippage is what turns a normal down day into a historical event. Think of the market as a bridge. Liquidity is how many cars the bridge can carry. In calm weather, the bridge holds. In a storm, everyone tries to cross at once. Now imagine the bridge gets narrower in the storm because market makers reduce size. That's Friday. Same bridge, more cars, less width. And if you were holding a leveraged ETF like AGQ, it's like crossing that bridge on roller skates. A lot of viewers will say, my broker froze. My order didn't fill. The price on my screen didn't match the price on the news. That's not always conspiracy. It's often mechanics. During extreme volatility, platforms apply risk controls. They widen internal guardrails. They requote, They reject market orders that would fill too far away, or they route you into a thin book with a wide spread, so it feels like a glitch. But what's really happening is the system protecting itself from becoming the buyer of last resort. And that's the core truth. In a crash, you discover what your broker is willing to do and what it refuses to do. How a targeted attack would leave footprints. Now, I'm not here to sell you a villain, but I will tell you what to look for if you want evidence instead of vibes. A targeted attack would usually show sudden, large, repeated sell blocks hitting the bid at key levels, simultaneous pressure across correlated venues, unusually fast spread widening before the drop, liquidity stepping back early, and a clear profit motive afterward, like a sharp rebound paired with persistent physical tightness. On Friday, we saw conditions that can mimic those footprints, but those conditions also occur naturally when a crowded trade breaks. So the honest answer is, you can't diagnose intent from pain alone. You diagnose it from data. Silver isn't only a precious metal, it's also industrial input. And it's also a financial trading instrument. That triple identity creates a split personality. When the market is calm, those identities can move together. When the market is stressed, they separate. Paper traders can puke risk in minutes. Industrial buyers don't change procurement schedules in minutes. Physical holders don't change beliefs in minutes. So a paper crash can happen while physical demand remains stubborn. And that mismatch is exactly why silver has violent resets. The hardest part of a day like Friday isn't the chart. It's what it does to your mind. Because the mind wants a single cause. It wants a villain. It wants a button. It wants closure. But markets rarely give closure. They give probability. So if you're coming off a shock like this, here's the survival framework. Do not trade your emotions against a machine. Do not average down because you need to be right. Do not chase a bounce because you need relief. Instead, slow the tape down. Reduce decisions. Wait for structure to return. Scenario A, the V bounce. You get a violent rebound as shorts cover and leverage is already flushed. This happens if the dollar cools and the market realizes the rumor wave was noise. Scenario B, the dead cat bounce, a sharp rebound, and then a grind lower as the market digests the damage. This happens when liquidity remains thin and every rally meets trapped sellers. Scenario C, the range. Volatility collapses, and silver chops between bands while futures positioning rebuilds. This is what markets do when they're healing. Your job isn't to predict which one. Your job is to watch the signals that confirm which one. Final word. If you felt betrayed, you're human. Learn the machine. Overextend, bait leverage, break levels, remove liquidity, force liquidation, reset. Name the moves, and they stop owning you. Follow up? Comment plumbing. Physical versus paper? Comment delivery. Subscribe. The next move hits when it feels calm. Stay sharp. See you next step.